Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning. We're here to give you the sincere and actionable ideas that you need in order to improve the lives of yourself and your loved ones financially. And as we come deeper into the closing of Q1, that's, getting deeper into the month of March, I got to tell you, our 2026 thematic of high valuations, higher stakes, anything but dull. Yeah, let me refocus on that. Anything but dull. The markets, the economy have been anything but dull. I've seen inflation still not where we want it. I've seen the non-farm payrolls weaker than anybody anticipated for. I saw the revisement of GDP not nearly awesome. And of course, oil, exogenous shocks. What do all these things mean to you? What should you be doing about it? We're going to unpack a little bit of all of those items today. In the interim, if you want to connect, 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. Now, let me set the stage and really just make sure everybody understands kind of where we're at, and I think what the challenges are. You've got this cooling job growth, but you have a consumer who's remained steady. Everybody listening, you're like me. You've been doing your part. You're still spending. You're still going out to eat. You're still doing some travel and leisure. You're living comfortable, non-flashy lifestyles, but that cooling jobs market is definitely an issue. Now, is it an issue threatening the economic expansion right now? No, it's not. This economy is still growing. And we do very, very well as long as unemployment rates are staying below that 5% and change number. And we're there now, but you got to put it on the radar screen. The second thing I'm thinking about is the CPI data. Depending on whether you do core or non-core, you're still running in that 2.9 to 3.1% range. Nowhere near the 2% target that the Fed told us they wanted to have. But I do believe if and when, and it's not if, it's when energy prices come back down, as shelter costs continue to back down, as there's a little bit less wage growth, you are going to see the year-over-year inflation data get into the mid to low twos potentially by year end, right? So inflation right now is a problem, but it could be okay. The next thing on my list in terms of the challenges, you got to mention it, is that the government spending is outpacing the revenue. And when you spend more than you collect, that obviously creates a deficit. And the CBO, the Congressional Budget Office, of course, projected the full year deficit to be some $2 trillion. Now, we need to keep America safe. We need to keep her citizens safe. We need to keep our business, our enterprises safe. And there's a cost to that. But we also have to pay attention to the fact that the fiscal strains on this country are getting larger. And you see that playing out in treasury yields. You see it playing out in currency markets. And all of those things need to have consideration. Next, as we're talking about my list of challenges right now, talking about the world that we live in, I do mention valuation. Now, remember, when you're investing in so many different things. You're not just investing in the S&P 500. But what I remind people is the S&P 500 has this PE, the price relative to earnings. And I just want people to know that the PE as it sits today is still well above the long-term average. That in and of itself is not dangerous, but we have to recognize and be vigilant, because when markets correct, we're ultimately correcting for valuations, and high PEs are a valuation that may eventually need to be corrected. But I mentioned that for the S&P 500. I didn't say that for small caps, S&P 600. I didn't say it for mid caps, S&P 400. I didn't say it for EFI, Europe and Far East. I didn't say it for EM. So listen, there's different parts of the market, and not all things have the same issues. Next on my list of challenges that we're dealing with in 2026 is you have to realize that it's a midterm election. And everybody says politics don't affect markets. They're mutually exclusive. They are, but this is just meant to be a history lesson. Midterm years, and last time I checked, this is a midterm year. Midterm years are notoriously the choppiest phase of the presidential cycle. Oftentimes seeing an average intra-year, that means during the year, intra-year drawdown of 17%. Now, we're nowhere near that. And that doesn't mean it has to happen. But it does mean when we look at the history of midterms overlaid with markets, I think midterms beset volatility. I think volatility for investors can be viewed through the lens of opportunity, and people just need to know that the midterm is typically the weakest return year and the most volatile year of that 4-year election cycle. Will it prove out to be the case this year? I don't know. Sure feels like it so far. And that's why our investment theme for 2026, if you're just joining, is high valuations, higher stakes, anything but dull. Connect with us, 833-964-PLAN, 833-964-PLAN. Go out to our website, getretiredstayretired.com. Well, I just gave you some of the challenges, maybe you would call them headwinds. What are some of the tailwinds? Well, don't forget that all of these things coming through don't affect the fact that the Federal Reserve, who controls interest rates, controls borrowing, is focused on stable prices, and they're focused on jobs, maximizing employment. And as we continue to see that weakness coming through the job market, I don't think it's out of bounds to expect that we potentially get 2 rate cuts in that period of time, September through December. Now, assuming that comes through, that is still stimulus. Remember the old wives' tale, don't fight the Fed. If the Fed is cutting rates, that's good for investors, generally speaking. Tailwind number 2, I call it a tax tailwind. I mean, don't forget that OBA, the One Big Beautiful Bill Act, passed on the 4th of July last year. Don't forget the fact that people got expandable and refundable child tax credits. Don't forget that there's a new tax form. It's called Form 1A, 1 Alpha. That's where you write down your tip income, your overtime income to be it non-taxable. Don't look past the fact that people who are 65 or older get this new senior bonus deduction. Don't miss the fact that the SALT cap just grew from 10,000 to 40,000. Business owners back to 100% bonus depreciation. What does all that mean? I think stimulus in terms of refunds, stimulus in terms of owing less money, all that stimulus courtesy of the tax plan is starting to arrive right about now. And I can't think of a better time for it to arrive than right about now. And while I said the jobs market's becoming a bit of a headwind, you could also argue the jobs market is still kind of a tailwind because the labor market's cooling. It's not collapsing. Let me say that again. The labor market's cooling. It's not collapsing. So slow and steady marginal roll-offs from all the excess hiring that happened during COVID, I think it's normal. Next on my list of tailwinds, profits, they look anything but recessionary. Profits do not look recessionary. And maybe most importantly, the economy in the United States of America might be stronger than consensus believes. Let me say that again. Maybe the economy in the United States of America is stronger than what people actually think, meaning it's stronger than consensus. So if all that's true, the theme of this year, high valuations, higher stakes, anything but dull, I think so far we've got this pegged pretty good. What are the strategies and things you should be implementing to make sure you navigate these waters with consistency relative to your risk budget that is derived from your financial plan so that you too can thrive in retirement, so that you too can get retired and stay retired? That's what we're going to be talking about all throughout today's show. What do I want you to do? I want you to connect with us online. Go out to our web address, getretiredstayretired.com. What do we do when we do it well? We're a multifamily office for those that are ready to put it all together, those who want a much more holistic view. You want the taxes, the estate and legal, the disciplined financial planning with the subset that is retirement cash flow planning, all backed by a strong investment presence under a fiduciary standard, the retiree health care, the long-term care. That's what I call end-to-end wealth management. That's what the VestGen client experience is all about. Stay tuned, more to come. Our top 6 for 26 coming up after the break. Craig Bolanos.
It's more In the Know Radio with Craig Bolanos on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
All righty, we've been talking about the fact that 2026 has been anything but dull. Higher valuations, all these components. So what are my 6 things that people really need to be paying attention to, that people really need to lean into in order to be successful this year? Well, that's what I call 6 for 26. Number 1 on my list: buy the dip, sell the rip. Wait, what do I mean by buy the dip, sell the rip? I'm not saying that in a very callous or carefree way. What I'm mentioning is this: volatility should be viewed through the lens of opportunity. I say that again. Volatility can be used through the lens of opportunity. I just think people are going to have to be a little bit more active amid all the uncertainty. That does not mean getting all in or all out of equities. Just what it means is using some common sense and looking as this market becomes fractured to seek small opportunities, small incremental improvement at the margins with what you're investing in to drive the strong risk-adjusted results. That's what it's all about. I would also argue that after multi-years of gains, President Kennedy had said the time to repair the roof is when the sun is shining. There's nothing wrong with taking investment profits and turning them into real profits. It's a great time to do the home repairs, a great time to take the vacations, a great time to do the vehicle replacement, because you're using capital while capital is still priced at or near all-time highs. So what's number 2 on that list of 6 for 26? Well, after you're being more active amid the complexity, AKA buy the dip and sell the rip, I gotta have you go global. And that probably feels odd. That probably feels uncomfortable right now because of what's unfolding in the Middle East. But I encourage you to pay attention to the fact that there remains tremendous amounts of concentration risk within a single cap weighted indice like the S&P 500, where you've got the top names, the top handful of names representing almost 40% of the index. So there might be 500 companies in the S&P 500, but there's only 10 companies that really control and influence that index on a daily basis. And the reason for this idea of going global, there's some facets that underpin it. Going global means not just being a domestic US investor. You got to have enough money overseas. And one of those is the dollar. And again, this de-dollarization trend is probably secular. There's a lot of countries that don't want to be as dollar denominated as they once were because they're upset with trade. I think trade is getting back to being fair, but other people think trade is now not fair. Well, here's the reality. The US dollar still remains the world's reserve currency. When all hell broke loose a week and a half ago with our, attack into Iran, where did money go? It went into the US dollar. That tells me that we remain the safe haven, the flight to quality. But longer term, you're going to continue to see other countries not sell dollars, but you're going to see other countries continue to put money in other places as a storage of value. That could be the euro, it could be the British pound, it could be in Japan, it could be in precious metals. And that just means if there's not as much dollar demand, the dollar's probably going to weaken. Pair that with maybe 2 interest rate cuts later this year, the dollar will continue to weaken. And why do you care? Because a weakening dollar acts as a tailwind for international investments if you happen to be a US citizen. Next on my list of why you've got to go global as we talk our 6 for 26, just know that US outperforms international or international outperforms US over long stretches, okay? I mean, since 1975, so we're going back some 50 years, the outperformance cycle for US versus international and vice versa is approximately 8 years. So on average, US is going to do better than international, or international is going to do better than the US for 8 years. Well, I got news. The US just did better than international for 14.6 years. That's almost double the normal pace of time. And it appears that the secular winds are finally starting to blow the other way. So you don't have to be early, but you got to start getting onto the global trend. 833-964-PLAN. That's 833-964-PLAN. Connect with us online at getretiredstayretired.com. That's getretiredstayretired.com. When you're on the website, download for free any of our publications like Investment Outlook 2026, 2026 Tax Planning Guide, or IRMA for all of those of you who are still dealing or still rattled with the fact that you're paying more for Medicare. Look at our IRMA reconsideration. That's a guide to lowering Medicare premiums after a life change event. All right, all of that can be downloaded for free at getretiredstayretired.com. So we're talking about our 6 for 26 because all of us are navigating a market and an economy that has higher valuations, higher stakes, and is anything but dull. And number 3 on my list of 6 for 26, after we're buying the dip and selling the rip, after we're going global, is a reminder that there's a shifting paradigm for portfolio construction. Where exploring alternative dimensions in private markets makes sense. And understand that the next frontier of investing is not a new asset class. Rather, the next frontier of investing is a new way of giving people access. Because as the number of public companies and opportunities continue to shrink, well, the number of private companies in the marketplace, those naturally continue to expand. And the challenge has never been the value of private markets, but rather the format and liquidity of accessing. Because the most traditional limited partnerships require capital calls, decade-long lockups, and patience through something I call a J-curve of early negative returns. All of those are very unfamiliar features to those who are accustomed to daily valued vehicles like stocks and mutual funds and ETFs. But we're at a place in time that I think investors need to look at private markets. And if investors can look at private markets in a way that's a reflection of what they want to accomplish, risk on, or most certainly risk off, I think now is a wonderful time to do it, because we think about this seismic shift that's happening. We think about, again, innovation and disruption. And even as we think about artificial intelligence, sure, you can own the semiconductor companies. Sure, you can own all of the cloud storage companies. But what about all of the infrastructure? How do you access the infrastructure that's going to be needed for the increasing amount of data centers, the increasing amount of fiber optic networks and cell towers to transmit that data, the increasing amount of power generation that's going to be needed? And whether you want to do this on the real estate side as a landlord, whether you want to do it on the lending side like a bank, whether you want to do it in so many different fashions, I think it just bodes well to be thinking of the fact that, number three, there's a shifting paradigm in portfolio construction, and maybe being 60-40 isn't the best place in today's environment. As we talk about our 6 for 26, the next on my list is, I was very proud of how well the U.S. did in the Winter Olympics. I mean, after all, it doesn't snowfall through the entire country, but we still kick some butt. Number 4 on my list is quality takes the gold. I think if we're in a period of time with higher valuations, higher stakes, anything but dull, you got to find a way to focus on attractive price to free cash flow, cash cows, and high ROE, return on equity companies. And part of that means dividends. Remember, dividends defend against volatility. And I think this market's going to broaden. This market is going to continue to broaden. So what can you be using? Because dividends defend against VIX. Now, if you want to learn more, if you're ready to start thriving, not just surviving in retirement, you realize that once you retire, all you care about is staying retired, I want you to connect with us. Take advantage of a complimentary financial consultation. Go out to getretiredstayretired.com. That's getretiredstayretired.com. Give us a call at 833-964-PLAN, 833-964-PLAN. And when we come back, I'm going to talk to you about number 5 and number 6 on our 6 for 26. You've been listening to Craig Bolanos, in the know on AM 560, The Answer. I'm the co-founder, wealth advisor at VestGen Wealth Partners. We'll be right back. Information you've got to have after this break.
You want more in the know radio? You want more in the know radio? You can't handle more in the know radio. Okay, yeah, you can. And it's on AM 560, The Answer. Welcome back. Here's more with Craig.
So we've been talking about the market, everything but anything but dull in 2026. And I was giving you my 6 for 26, 6 considerations that I think investors need to be paying attention to in order to navigate these waters and be successful. And that brings us to number 5. And number 5 is just bolstering cash reserves. I call it staying retired with dry powder. You know, it's tempting to want every dollar to work, especially as money market yields, CD yields, saving yields have all compressed. But I think it's important to remember, I kind of hearken back to what I said earlier when I said staying active amid the complexity, that people should be fixing the roof when the sun is shining. My comment here is, don't be afraid to trim equities with us to align with the risk budget that's done in concert with your family's retirement plan. Don't be afraid to redirect some equity exposure into other things that are long-term storages of value. Not because we're fearful of a recession. We're not in one. Not because we're fearful of global conflicts. We always have exogenous shocks that pull up. Not because we're worried about some secular cataclysmic black swan event. There doesn't appear to be any right now. But don't be afraid if that portfolio that was 60-40 has grown into 70-30, or if that 80-20 portfolio grew into 90-10 because of the stock market gains over the last several years. Don't be afraid to reposition portions of monies into hard assets, whether those hard assets are real estate, whether those hard assets are precious metals, whether those hard assets are commodities, whether those hard assets are simply treasuries and other bonds to store value. All of that should be on the table, and I think it just makes sense to do. Number 6 on my list, and no one likes this, but it's that returns come back down to earth. Let me say it again. Returns come back down to earth. That doesn't mean that stock markets decline. It does mean, though, that when you start the year with elevated price to earnings ratios and you remain dependent on assistance from the Fed, productivity gains from artificial intelligence, stimulus from tax refunds, and deregulation, it's not likely that there's going to be any multiple expansion. The growth is only going to come, the growth in stock prices is only going to come from earnings at this stage. And stocks, they don't normally move at double-digit earnings growth, as earnings are typically high single digits, and that's why you stack dividends, income, and other investments on top. So don't be afraid that returns come back down to earth. Just know that everyone's got recency bias. Everybody assumes that what happened recently is going to continue to occur. And if you look back over the last 10 to 15 years, you see that we had all of this fiscal stimulus, the CARES Act, the American Rescue Plan, the infrastructure bill. We had all of this Federal Reserve stimulus, the years we spent at zero interest rates, in addition to the massive balance sheet transactions that the Fed was doing. And then tax stimulus. Remember the Tax Cut and Jobs Act, the One Big Beautiful Bill Act last year? I mean, those are swan songs in all of those things now. So we just have to recognize that if markets are going to go back to normal, which means returns kind of come back down to earth, then income is going to be a more important component of total return. And income comes from things like dividends. Dividends defend. Income comes from interest. That's interest income. That's what you collect when you're lending money. That's what you collect in fixed income. That's what you collect when you're acting as a bank. Income also can come from rent when you are effectively acting as a landlord. And it's important that people structure their income in such a way that their income is growing over time. Because what you have to focus on if you're going to be retired for 20, 30, 40 years, it is not, I know that would be nice, 40 years, but hey, I've met 2 centenarians in the last 12 months. Yep, I've met 2 centenarians in the last 12 months. Guys, it's happening. You retire at 60, you couldn't be a centenarian and make it to 100. My point is, you're not just focused on cash flow or income, starting income. You're focused on growing income. You're focused on rising income. You need to make sure that you're investing in such a way that your income's going to grow. And that's why it's one of the 3 pillars of retirement income for us at VestGen Wealth Partners. Pillar number one, capital matters, capital matters, capital matters. We get it. Once you retire, everything you have is pretty much all you're ever going to have. We understand why that mindset of not going backwards matters so much. But you need to pair that mindset of capital matters with an understanding of the distinction between true risk and volatility. And you have to pair that with pillar number two. And pillar number two is retirement's never been about assets. Retirement's always about income. And that's why pillar number two is you have to find a way to generate sufficient interest, payments, distributions, dividends to cash flow your spend. Because if you're living off of the income, then you're never going to have to touch the corpus of the principal, which puts you in a very good place. And then pillar three, because of inflation, and inflation is the silent killer when it comes to retirement plans, you got to have a way to grow your capital base still over time in order to grow your income, grow your cash flows over time. Because I know this, if you've been retired for a while, your property tax bill probably already doubled. If you've been retired for a while, you've seen a lot of your costs already double. And I don't want anyone listening to be a fallen angel. Fallen angels are those retirees who get out early and the first 12, 15 years of retirement's just fine. But then they start to realize between the cost of their health care, the cost of their property taxes, the cost of everything in life, their monthly income isn't going far enough anymore because the purchasing power has been eroded by inflation. And now they're compromising on choices, compromising on lifestyle. That's surviving retirement. You're not going to do that. We're going to help you thrive in retirement by creating a program that allows you to grow your income over time. That's why those three pillars of retirement income are so mission critical. So I want you to connect with us at getretiredstayretired.com. Go out to that website, getretiredstayretired.com. Take advantage of a complimentary consultation. Download for free our Investment Outlook 26. Download for free our 2026 tax planning guide. It's tax season, guys. And for anybody who hasn't dealt with IRMA, a lot of people got letters in January. What's your guide to lowering Medicare premiums? Well, we've got that for you too. But I want to reinstill faith and confidence with everybody that doesn't have enough faith in the traditional model of financial advice.
The answer.
I want you to have an experience that is holistic, an experience that's end to end. And that's exactly what you're going to get when you connect with us. I'm Craig Bolanos, co-founder, wealth advisor, VestGen Wealth Partners. You're listening to In the Know, AM 560, The Answer.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560, The Answer.
Hey, it is the season when you're doing your taxes. Just about all of your 1099s, your simplified K1 should be hitting your inbox right about now. And you know that we opened up for tax filing in America on the 26th of January. And you know that the 2025 season is the first time in your life that you're doing things under a new tax law we call OBA, the One Big Beautiful Bill Act. And there's a ton of new changes that are out there. And here's 8 that I think are significant and the planning opportunity that comes with it. Number one, please remember the standard deduction for 2025 taxes is bigger than ever. We're talking about a standard deduction of more than $31,500 for married couples. Wow. That means if your mortgage interest, property taxes, charitable contributions are less than $31,500 and you're married, you're just taking the standard deduction. And the implication of that for a ton of Americans is we're probably staring at 94% of America not itemizing. You're just taking the standard deduction. And if you're just taking the standard deduction, what's the benefit to you anymore of having a mortgage interest deduction? What's the benefit to you of writing checks to charity? Now, you need to give to charity because ministry needs money, but that large standard deduction should cause you to pause and think carefully. I'm going to talk more about that in a minute. Number 2 on these 8 talking points of income taxes is, remember, that SALT deduction cap has increased. Well, at least for now, it's temporary. So the Tax Cut and Jobs Act capped the state and local tax cap at 10 grand. And a lot of people in high tax states, Illinois, New York, Connecticut, New Jersey, California, have been mad for a long time. Well, it got raised to $40,000 this year, but there's a income phase out. So if you live in a high tax state and you've got a high amount of SALT taxes, you need to know what the line in the sand is, that modified adjusted gross income, and maybe take some strategies to stay below the cap so you too can maximize your SALT deduction and get back to itemizing. Number 3 on my list of 8 things that are significant in this tax season is know that the child tax credit, the amount changed and the rules changed. So the first thing is for 2025, the tax credit, this thing's up to $2,200. We're trying to encourage people to have kids. Part number 2 is about $1,700 of that credit is refundable. So yeah, this thing is a refundable tax credit. But once again, what do parents need to be thinking about? Parents need to be thinking very carefully about the income restrictions if you want the credit. And remember, a credit is way more valuable than a deduction because a credit is dollar for dollar. Number 4 on my list, and this is the big one. It was framed as Social Security being non-taxable, but what it really is beginning with the 2025 tax year, this 2026 season, what you're seeing is that individuals 65 and older can claim an additional $6,000 deduction on top of the standard deduction. So married couples, your standard deduction's $31,500 out of the gate. You can stack an additional $12,000 on top of that to be at $43,500. Oh my gosh, let me say that again. To be at $43,500. That's huge. You're probably definitely not itemizing if you're in that camp. But again, that senior bonus deduction, it's income controlled once more. And given if you're married and there's 2 $6,000 deductions, $12,000 on the line, what are you going to do in this subsequent years to make sure you don't forgo that? So income planning is even more important. In fact, I told some clients who have loved doing Roth conversions, I'm like, I got news. You're probably not doing a Roth conversion because I don't want to forgo your senior bonus. That doesn't apply to everybody, but it applies to some. Next on my list, my top 8 big changes. Schedule 1A. Schedule 1A. Well, what in the world is Schedule 1A? It's that new form that allows you to do things you've never been able to do before, like deduct the interest, pay it on a loan to buy a car. Yeah, that's right. Did you know if you get a car where the final assembly of the car happened in the United States, you could possibly deduct up to $10,000 of auto loan interest? In addition to that, this Schedule 1A, the new tax form, that's where workers can claim new deductions, like the deduction of qualified tip income, the deduction of overtime income. Oh my gosh, that's huge. That's huge. That's putting more money in people's pocket exactly at the point in time they probably need it. Number 6 on my list is the IRS. This is more of a FYI, if anything, piloted a free direct tool in certain states for the past couple of years. I call it IRS Direct File. Just know that it's gone. So if you were using IRS Direct File, that's gone. All right, number 7 on my list. We finally got some definition, finally got some relief for casual sellers on those 1099Ks. Remember, all these third-party payment platforms remain a major source of information for the IRS. And instead, what's happened is, all these people who are doing online retail, online sale, think about it. Your spouse, someone's got like a small side hustle of like an Etsy business. We finally got the agency to give us better clarification and make an amendment to what used to be this crazy, controversial $600 threshold, a $600 threshold for Form 1099K. That's no longer here. Thankfully, we moved it up to 20 grand, and that's going to make things easier. Business owners, I'm talking to you. Number 8 on my list, I save it the best for last. For 2025, we're back to 100% bonus depreciation. Full expensing is available, and that's a big deal. So when you buy things, because you're investing in your business, you're an independent business owner, you are the employer, the economic engine of this country, you're finally being seen, you're finally being heard, and once again, you're getting full bonus depreciation, full immediate expensing. And that's what you should, because we want you to invest in yourself, business owner, because investing in yourself is investing in America. That was a lot. Here's the point. It's not just a retirement plan thing. It's a retirement cash flow thing, backed by an investment thing, paired with a tax strategy thing, married with good solutions for retiree healthcare. And when you bring all of those professionals, which are multiple disciplines, under one roof, then you can start seeing progress in the totality of your finances. And boy, that is absolutely what matters. And if you want to learn more, you can. If you want to learn more, you should. And here's how you're going to do it. You're going to connect with us online at getretiredstayretired.com. That's getretiredstayretired.com. You're going to call us at 833-964-PLAN. That's 833-964-PLAN. And we're going to get you into a spot, into a place where we're going to help you not just survive, but start thriving in retirement. You're listening to Craig Bolanos, co-founder, wealth advisor, VestGen Wealth Partners. This is In the Know Radio on the station with all the answers. That's why we affectionately call it AM 560, The Answer.
Okay, Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560, The Answer.
So we covered a ton of ground today. If you caught the segments in the A block where we really focused our time was going over the investment theme for the year. High valuations, higher stakes, anything but dull. And we spent our time sharing with you the challenges, or what some people refer to as headwinds. And we broke down what too few people are talking about, which is the tailwinds. And ultimately, those tailwinds are resulting in one theme. The U.S. economy might actually be stronger and could potentially be more resilient than what consensus would have you believe. That sets up something positive. Then In the B block, we spent our time giving you the 6 for 26, 6 pieces of discernible action, 6 considerations that regardless of whether you're accumulating wealth, maintaining wealth, that you need to have in today's environment of, again, higher stakes with higher valuations, a time period that it's anything but dull. And I hope you got some good feedback as we talked about the significant tax changes that went into effect. And these are all positive. No one's losing on these. But so many of these tax changes are temporary. They're not all permanent. And so many of these tax changes are all income tested, meaning you got to pay attention to these new lines in the sand for your modified adjusted gross income if you too want to reap all the benefits. And then I remind you, why do I do this radio? I do it because I'm passionate. I'm passionate that we want to put good in the world. I'm passionate that I want people to have improved outcomes. I am so passionate, as is the entire team at VestGen, that people do better. There is so much information. I call it intellectual quotient, IQ, available to everybody, courtesy of the internet. But harnessing that information and turning it into a different form of IQ, implementation quotient, that's so important. And those are things we do, and we do them well. And you're ready. You're ready for a more robust experience. And I want you to experience exactly that. Learn more about us by downloading some of our free publications at getretiredstayretired.com. Take advantage of that complimentary consultation and let us help you get retired and stay retired. 833-964-PLAN, 833-964-PLAN, getretiredstayretired.com.